We've all seen the headlines. AI stocks are printing money and the market is setting records. But here is the question that keeps most investors up at night. Are we in an AI bubble? Today, we will look into two distinct groups of companies, and both are considered to ride the AI wave, but they're separated by financial chasm. On one side, we have big companies, giants, big tech like NVIDIA, Microsoft, Google, and Amazon. And we have another point of view where we're looking into high flyers like Tesla and Palantir. And also, we're looking into disruptive technology companies like Oklo or Archer Aviation. We're going to look at their fundamentals to determine which of these groups is a legitimate breakthrough and which one is based purely on hype. So stick around, because by the end of this video you will know how to tell the difference between a great business and a very expensive IOU. I'll start with NVIDIA. Yes, the price moved up more than 10x in the last 5 years, but the reason is that they are the main beneficiary of the AI trend. They control more than 80% share of the AI chips industry, meaning when we read news that companies like OpenAI, Oracle, or Google are investing hundreds of billions in AI infrastructure, a big portion of that spending is coming to NVIDIA's top line. I'll open the revenue chart so you can see with your own eyes what I'm talking about. In 2023, they generated $32 billion revenue, while in 2024, they generated $96 billion. That's 3x, isn't it? If we switch to quarterly chart, you will see that they generated around $90 billion in revenue in the first 2 quarters of 2025, meaning they're likely to double the revenue of 2024. Let that sink in. This is the biggest company in the world. They generated $32 billion in 2023, and considering their guidance for next quarter is $54 billion, without considering any sales in China, we can safely predict around $200 billion in 2025. It's important to mention that their operating margin also increased, which leads to higher net and operating income. Their trailing PE ratio is 53, and if you look at their chart, you will see a nice downtrend. But if you look at the forward PE, it is dropping below 30, currently 28. Do you see a bubble here? Let me know in the comments below. If you've watched until here, it means my content is valuable to you. That means a lot to me, and I would greatly appreciate it if you could click the like button and subscribe to my channel. Next is Microsoft. This is one of the most predictable companies in the world. Look at their revenue chart. It's almost a straight line going up, and it's very likely to continue. The free cash flow growth also looks nice. The company is generating so much cash that we don't see their massive capex affecting their free cash flow. The company seems a bit expensive with trailing PE ratio of 38 and forward PE of 33. But let's go back to their capex and look into it. I think it's good to mention it, as the case is very similar for Microsoft, Google, and Amazon. As you probably know, these are the biggest cloud providers in the world. They are investing massive amounts in capex in order to improve their cloud and AI infrastructure. The demand for their services is so high that they don't have enough capacity to meet it. Cloud is a business with very high switching costs, so once they acquire a customer, they're very likely to retain them for the long term. Again, the valuation seems a bit high, but when we look into fundamentals, it is nowhere near to being a bubble. Regarding Google and Amazon, these are my two biggest holdings, and I've bought a lot this year. On top of their big capex investments, their valuation is much lower than Microsoft and Nvidia, with Google's forward PE sitting at 24. I have a video on my channel where I talk more about the company. I'll put a link here. I will soon post about Amazon, so if you want to watch it, it might be a good idea to click the bell button. I have positions in all four companies that I just mentioned, and I will be very comfortable holding them even if the so called bubble bursts. I'm even waiting for that moment so I can use the general sentiment to buy more at a discount. Ask yourself, would you buy Microsoft or Google if their PE ratio drops to 15x? Now let's look into Tesla's fundamentals. Their revenue is flat for the last 3 years. Their sales are dropping. Elon Musk's political career has likely damaged the company so far. Their operating margin has dropped from 19 to 5%. In the same time, their stock price has doubled in the last 1 year. Why? Because of the narrative of autonomous driving and future robotics, a narrative that current fundamentals cannot justify, leading to sky high PE ratio in the range of 200. In the same time, Tesla is far behind Waymo in autonomous driving, and they don't have a working humanoid robot yet. What do you think about the company? The video is getting more interesting now. Palantir seems to be an amazing, fast growing company. Its growth is everywhere: revenue, operating margin, net income. But the fastest growth is in their price. The stock has jumped a staggering 320% in the trailing 12 months. The valuation here is ridiculous. Trailing PE is 600x, while forward PE is 200x. But this is not the most ridiculous metric. Price to sales ratio is currently sitting at 126, meaning that Palantir's market cap is 126 times higher than the revenue they generated in the trailing 12 months. Again, I'm not saying this is a bad company. I believe Palantir is a great company and it is here to stay. But their price has significantly outpaced their growth, creating disconnection between price and fundamentals. That seems more like a bubble, doesn't it? Now let's switch to Oklo. Oklo is a nuclear power company that is in the process of developing small modular reactors. Now, I'm definitely not a nuclear power specialist, but the story here is that the AI data centers consume quite a lot of energy, so nuclear power comes handy here. There are several companies that are competing to develop small modular reactors in the Western world, but at this moment we have zero operational SMRs. Nevertheless, Oklo's stock price has increased around 474% year to date and 9x since their SPAC merger last year. The company has generated zero revenue and it is not likely to have any sales in the next few years. But their market cap is $20 billion. I don't know if the company will be successful. As I mentioned, I don't know the nuclear industry, but I know that this company is up only because of the narrative. I also know that C level executives in the company are selling their stocks. Do you think that's a bubble? Leave a comment if you think there is something I'm missing here. Similarly, Archer Aviation, an eVTOL developer, which means flying cars, has no commercial revenue and is also massively free cash flow negative, burning hundreds of millions a year on development and manufacturing. Its valuation is based solely on future pre order books and the successful certification of an aircraft that doesn't yet generate any profit. There are many similar examples of companies and whole industries that are attracting investor funds only because of narrative, prior to generating any revenue. While those companies and industries are insignificant compared to the market cap of NVIDIA and Microsoft, I see many retail investors are driven by fear of missing out. And if there is any setback, even a minor one, we might see that particular bubble popping. So, are we in an AI bubble? I strongly believe that the hyperscalers are missing the most important quality of stock market bubble, this connection between price and fundamentals. While the other companies I mentioned have high expectations priced in. As an investor, your job is to know which game you're playing. Are you investing in solid cash flow or are you speculating on a story? Let me know in the comments which group you think is the better long term bet. And don't forget to like and subscribe, it really makes a difference. See you soon.